Imagine waking up one morning, opening your phone, and discovering that some of the world's biggest AI companies have lost hundreds of billions of dollars in market value in just a few days. Companies that many investors believed could only keep going up suddenly turned red. So, what happened? Is this just another temporary market correction? Or is the AI bubble finally starting to burst? Stay with me, because by the end of this video, you'll understand what's really happening, and more importantly, what smart investors are watching next. Artificial intelligence has been one of the biggest investment stories of the past few years. From powerful AI chatbots to self-driving technology and advanced robotics, AI has captured the attention of businesses, governments, and investors around the world. Companies building AI chips, cloud infrastructure, and AI software experienced extraordinary growth. Their stock prices climbed rapidly, attracting even more investors who didn't want to miss what many called the next technological revolution. For a while, it seemed like AI stocks could only move in one direction, up. But recently, the market told a very different story. Several AI-related technology stocks experienced a sharp pullback, leaving many investors wondering whether AI company valuations had become too expensive. So let's break everything down in the simplest way possible. To understand today's sell-off, we first need to understand why AI stocks became so popular in the first place. Everything accelerated after powerful AI tools showed the world what artificial intelligence could actually do. Businesses suddenly realized AI wasn't just a futuristic idea, it was becoming a practical tool that could increase productivity, reduce costs, and create entirely new products and services. Almost overnight, companies across industries began investing heavily in AI. Banks explored AI for fraud detection. Hospitals used it to improve medical research. Retail companies adopted AI to personalize shopping experiences. Manufacturing companies introduced AI-powered automation. Governments also increased funding, recognizing AI as an important technology for future economic growth and national competitiveness. Meanwhile, technology companies invested billions of dollars building massive data centers, designing faster AI chips, and expanding cloud infrastructure capable of supporting increasingly powerful AI models. As excitement continued to grow, investors became even more optimistic. Many believed AI would transform nearly every industry over the next decade. That optimism pushed AI-related stocks to record highs. But markets have an important rule. When expectations become extremely high, companies have to deliver extraordinary results just to satisfy investors. Sometimes even good news isn't enough, because investors were already expecting something even better. So why did AI stocks suddenly fall? There wasn't just one reason. Several factors came together at the same time. The first reason is valuation. A company's stock price reflects not only what the business is worth today, but also what investors believe it could be worth in the future. Over the past few years, many AI companies saw their stock prices rise much faster than their actual earnings. Eventually, investors started asking an important question. Have these prices moved too far ahead of reality? The second factor is uncertainty. Financial markets dislike uncertainty because uncertainty makes future profits harder to predict. Concerns about economic growth, interest rates, inflation, and global trade all influence investor confidence. When uncertainty increases, many investors reduce their exposure to riskier assets and move some of their money into investments they consider safer. The third reason is something called profit taking. Imagine buying a stock before it doubles or even triples in value. After earning a significant profit, many investors simply decide it's a good time to sell some of their shares and lock in those gains. That doesn't necessarily mean they've lost confidence in the company. They're simply protecting the profits they've already earned. When enough investors do this at the same time, stock prices can fall, even if the underlying business remains strong. This is why it's important to remember that a falling stock price doesn't automatically mean a company is failing. Sometimes the business itself is still performing well. The market is simply adjusting its expectations. And in investing, expectations can often move prices just as much as actual results. So, does this recent sell-off mean the AI revolution is over? Probably not. History has shown that major technological breakthroughs rarely move in a straight line. Think back to the internet boom in the late 1990s. Investors were incredibly excited about the future of the internet, and technology stocks reached extraordinary valuations. Then the dot-com bubble burst. Many companies disappeared completely, but something interesting happened afterward. Businesses with strong products, real customers, and sustainable business models eventually recovered. Some of them went on to become among the most valuable companies in the world. A similar pattern appeared during the smartphone revolution. When smartphones first became popular, expectations were enormous. There were periods of rapid growth, followed by market corrections and uncertainty. Yet the companies that continued innovating eventually created tremendous long-term value. The same story unfolded during the rise of cloud computing. At first, many investors questioned whether businesses would truly move their operations to the cloud. Today, cloud services have become essential to modern businesses across nearly every industry. Every major technological revolution follows a similar cycle. First comes excitement, then rapid investment, then extremely high expectations. After that, markets usually experience corrections as investors become more realistic about future growth. Artificial intelligence may be following a similar path. Companies creating genuine value through innovation, strong products, and growing profits could continue expanding for many years. At the same time, companies relying only on hype may find it much harder to meet investor expectations. This is where experienced investors often think differently from beginners. Instead of reacting emotionally to daily headlines, they usually focus on the long-term fundamentals of a business. Rather than asking whether a stock went up or down this week, they ask much more important questions. Is the company's revenue continuing to grow? Is the business becoming more profitable over time? Does it have a competitive advantage that competitors will struggle to copy? Can it continue growing over the next 5 to 10 years? These questions matter far more than short-term price movements. A company's share price may fluctuate every day, but if the business continues improving year after year, many long-term investors believe the market eventually reflects that progress. Market corrections can sometimes create opportunities for investors willing to stay patient. However, it's equally important to remember that every investment involves risk. No company is guaranteed to succeed. No industry grows forever without setbacks. That's why diversification, research, and patience are some of the most valuable tools an investor can have. So, what happens next? There are two realistic possibilities. The first is that this is simply a normal market correction. If company earnings remain strong, AI adoption continues expanding, and businesses keep investing in artificial intelligence, investor confidence could gradually recover. In that case, today's pullback may eventually look like just another pause in a much larger long-term trend. The second possibility is that expectations remain too optimistic. If future earnings fail to match the excitement surrounding AI, the market could experience a longer period of slower growth and increased volatility before prices stabilize. The truth is, nobody, not even professional investors, can predict exactly what the market will do next. Markets are influenced by thousands of factors, many of which change every single day. That's why successful investing isn't about predicting every price movement. It's about managing risk, staying informed, and maintaining a long-term perspective. So, is the AI bubble bursting? Or is this simply another chapter in the long-term growth story of artificial intelligence? Only time will reveal the answer. But one thing is certain, technology has always experienced cycles of optimism, correction, and innovation. Artificial intelligence is likely to face challenges along the way, but it also has the potential to reshape industries for years to come. Now, I'd love to hear your opinion. Do you think AI stocks still have plenty of room to grow? Or do you believe the market has become too optimistic? Share your thoughts in the comments below. If you enjoyed this video and want more simple explanations about finance, investing, and the stock market, make sure to like this video, subscribe to the channel, and turn on notifications so you never miss an update. Thank you so much for watching. I'll see you in the next video.